Here's a number that should worry you. The number one ETF of the last decade returned almost 38% per year. That's 4 times what most financial advisors promise. Millions of retirees are looking at that number and thinking, that's where my money belongs. They're wrong. That ETF, the one that crushed everything else for 10 straight years, once dropped 85% from its peak. It took over 8 years just to claw back to where it started. If you were retired and pulling money out during that drop, you'd never recover. Not in 5 years, not in 10, not ever. Today, I'm going to crash test 9 of the most popular ETFs of the last decade, not by their returns, by whether they'd actually keep you alive in retirement. By the end of this video, you'll know exactly which of these 9 funds survive a real market crash when you're pulling income, which ones could quietly destroy your portfolio, and where to put each one so you don't get wrecked by a tax trap almost nobody talks about. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So let's look at the scoreboard, the one most people use to pick their ETFs. 10-year average annual returns. SMH leads at roughly 38% per year, QQQ around 22%, VGT at 20%, SPMO around 26%, then VOO at 15%, SCHD and VYM around 10 to 13%, VXUS around 10%, and JEPI around 7 to 9% since its launch. Ranked by return alone, you'd put everything in SMH. That's what the scoreboard tells you to do. But here's what it doesn't mention, the crash column. In 2022, SMH dropped over 33%, QQQ dropped almost 33%, VGT fell nearly 30%. Now look at the bottom. VYM barely moved, down less than 0.5%. SCHD dropped just 3%, JEPI about 3.5%, while paying you 8% in income the entire time. So here's the question. Which ETF do you actually want to own when you're 67 and your portfolio is your paycheck? Before I show you the crash test results, take a guess. Which one of these 9 funds do you think is the most dangerous for someone in retirement? You might be surprised. The crash test. Here's the thing about market crashes. If you're 35 and have decades ahead of you, a crash is a sale. You buy more shares at lower prices and wait. But if you're 65 and pulling $40,000 a year to pay your bills, a crash isn't a sale. It's a permanent withdrawal at the worst price. You're selling low, and those shares never come back. This is called sequence of returns risk, and it's the #1 killer of retirement portfolios. Let me show you what this looks like with real math. Say you've got $1 million. You need $40,000 a year to live on. A 2022-style crash hits your portfolio. Here's what happens to your money depending on which ETF you're holding. If you held VYM, after the crash and your $40,000 withdrawal, you'd still have about $956,000. You need a 5% gain to recover, a lazy year. SCHD, about $927,000. An 8% gain gets you whole. JEPI, about $925,000. Similar story. Now the other direction. VOO drops you to $778,000. You need a 28% gain just to get to even. QQQ, $634,000. You need a 58% gain. 58%. That's not a recovery, that's a prayer. And that's just a 2022-style drop. SMH has fallen 85% before. If that happened while you're withdrawing income, your portfolio is functionally gone. Here's the myth. The best ETF is the one with the highest return. Here's the truth. The best ETF is the one that doesn't collapse when you need it most. The crash test flips the entire scoreboard upside down. The worst performing funds by 10-year return are the ones that actually keep your retirement alive. The dividend shield. So now you know which ETFs survive crashes and which ones don't, but there's one more layer, and it's the part most people overlook: cash flow. When you're retired, you need income every month, every quarter. The question is, where does that money come from? If your ETF pays enough in dividends to cover your bills, you never have to sell shares. That means during a crash, your portfolio stays intact. You write it out, your shares recover on their own timeline, you don't lock in losses. But if your ETF pays almost nothing in dividends, every dollar you need comes from selling shares. And in a crash, you're selling at the worst possible prices. Let me show you the real numbers on $1 million portfolio. JEPI pays roughly 8.2%. That's about $82,000 a year on $1 million. It covers your withdrawal twice over without selling a single share. SCHD pays about 3.2%, roughly $32,000 a year. Covers 80% of your bills from dividends alone. VYM and VXUS are in the 2.3 to 2.6% range, covering about 58 to 65%. Now the growth funds. VOO pays about $11,000, QQQ $4,300, VGT $3,600, and SMH, the decade's champion, pays you $1,700 a year on $1 million. That covers 4% of your bills. So if you're holding SMH in retirement and the market drops 33%, you're forced to sell shares at the bottom, and the shares you sell, they're gone. They don't participate in the recovery. That's the double hit. Crash plus forced selling. That's what kills portfolios. Quick question before we move on. Which of these 9 ETFs are you holding right now, and which account is it in? Drop it in the comments. I read every single one, and I'll tell you if your placement might be costing you money. The 3 tax traps. So now you know which ETFs survive crashes and which ones cover your bills, but here's where it gets really interesting. The crash isn't even the most expensive part. The tax bill is, and almost nobody is talking about it. There are 3 hidden tax traps that could cost retirees thousands of dollars every year, and the wrong ETF in the wrong account triggers all 3. Trap number 1, the Social Security torpedo. Most people think taxes only matter when they sell an investment, but if you're retired and collecting Social Security, the dividends from your ETFs can trigger a cascade every single year. Here's how it works. The IRS calculates something called provisional income. That's your regular income plus half your Social Security plus your investment income. If that number crosses $44,000 for a married couple, up to 85% of your Social Security becomes taxable. Say you're 67 and married, you collect $30,000 a year in Social Security. You hold $500,000 in SCHB in a regular brokerage account. SCHD pays about 3.2%, so that $500,000 generates roughly $16,000 in dividends every year. Your provisional income, about $32,000 from other sources, plus $15,000 from half your Social Security, plus $16,000 in SCHD dividends. That's $63,000, well past the threshold. The result? You're paying taxes on 85% of your Social Security. And in that phase-in zone, your effective tax rate on each extra dollar of dividend income can hit 44%. Now, does that mean SCHD is a bad fund? No, it means SCHD is in the wrong account. Put those dividends inside a traditional IRA and they don't show up on your tax return until you withdraw. They don't trigger the torpedo. Problem solved. Trap number 2, IRMA. IRMA is a standard Medicare surcharge. In 2026, standard Part B costs about $203 a month, but cross $218,000 in income as a married couple, your premiums jump by over $2,300 per person per year. That's $4,600 for a couple. High dividend ETFs or a big capital gains year can push you over that cliff. Trap number 3, the RMD time bomb. Put a fast-growing fund like QQQ inside a traditional IRA, and it compounds tax-free for years. But at age 73, required minimum distributions kick in, and it's all taxed as ordinary income. Say you put $500,000 into QQQ in a traditional IRA. At 15% a year for 10 years, that becomes over $2 million. Your first RMD would be around $76,000, all ordinary income, and it grows every year. The fastest growing funds create the biggest forced withdrawals, and those withdrawals can trigger the torpedo and push you past an IRMA cliff at the same time. And here's a twist most people miss. JEPI, the fund that pays 8%, has its own tax trap. The majority of JEPI's income comes from equity-linked notes, not regular dividends. The IRS treats that income as ordinary income, taxed at rates up to 37%. So that headline 8% yield, after taxes, it can drop to about 5.5% for a higher earner. Still good, but if JEPI sits in a taxable account, that income is hitting your provisional income, triggering the torpedo and pushing you toward IRMA every single year. If someone you know holds JEPI or SCHD in a taxable brokerage account, they need to hear this part. Share this video with them right now. It could save them thousands. The account placement fix. So here's the good news. Once you know about these traps, the fix is straightforward. It's not about picking different funds. It's about putting the right fund in the right account. You have 3 buckets: a Roth IRA, a traditional IRA, and a taxable brokerage account. Each has different tax rules. Match each ETF to the bucket where it causes the least damage. Your Roth IRA. Growth compounds tax-free. No taxes on withdrawals, no RMDs. So what goes here? Your highest growth funds. QQQ, VGT, SMH, SPMO. And here's a move most people miss. JEPI belongs in a Roth too. Its ordinary income becomes tax-free. That 8% yield goes from 5.5% after tax to the full 8%. Big difference. Your traditional IRA. This is where dividends are shielded from the Social Security torpedo and IRMA until you withdraw. SCHD goes here, so does VYM. Their dividends don't touch your provisional income, they don't trigger the torpedo, they don't push you past a Medicare cliff. Your taxable brokerage account. This is where you put tax-efficient funds. VOO belongs here. It rarely distributes capital gains. And VXUS goes here because it gives you a foreign tax credit that you'd lose inside an IRA. That credit is worth roughly 0.25% every year, small but free money. Smart retirees don't just pick the right ETFs, they put them in the right place. The retirement scorecard. Let's put it all together. We've crash-tested 9 funds, run the dividend math, exposed the tax traps, and mapped the account placement. Now it's time for the real ranking, not by 10-year returns, by retirement survivability. Core tier, the funds you build your retirement around. SCHD gets the top spot. Low volatility, a 3.2% yield that covers most of your withdrawal from dividends, a shallow 3% drop in 2022 while the growth funds were falling 30%, and it grows its dividend about 8 to 11% per year, well above inflation. Inside a traditional IRA, it's sheltered from every tax trap we covered. Right behind it, VYM, even shallower drawdown in 2022, less than 0.5%. A 2.3% yield with 605 holdings, broad, stable, and boring in the best possible way. VOO is your growth backbone. In a taxable account, it's ultra tax efficient, and VXUS gives you international diversification. Every major firm is projecting international stocks to match or beat US stocks over the next decade. VXUS in taxable also captures that foreign tax credit, a roughly 0.25% every year, small but free money. Satellite tier, small allocations in a Roth. QQQ or SPMO, 5 to 10% of your portfolio. This is your growth kicker. It compounds tax-free in a Roth. You're not relying on it for income, and if it gets a great year, you benefit. If it crashes, your core holdings carry you through. JEPI earns a spot here too, but only inside a Roth. That 8% yield, tax-free, is genuinely powerful. Just don't put it in a taxable account or the income will cost you more than it pays. Avoid tier, for retirees. VGT and SMH, the decade's top performers by return, but VGT has nearly 45% of its money in just 3 stocks, Nvidia, Apple, and Microsoft, and SMH holds only 25 stocks total, 1 sector, 1 bet. These are incredible funds for a 30-year-old with decades to recover, but for someone pulling income, a 33% crash, or worse, an 85% crash, is a hole you never climb out of. And here's the final piece. The next decade isn't going to look like the last one. Vanguard is projecting U.S. large-cap growth at just 3 to 5% a year over the next decade. Value stocks, 5 to 8%. BlackRock, research affiliates, and GMO are saying the same thing. The S&P 500 CAPE ratio right now is over 41, one of the highest readings in history, and the Magnificent Seven make up about 1/3 of the entire index. If you own VOO plus QQQ plus VGT plus SMH, you could have 30 to 40% of your portfolio in just 3 or 4 stocks. That's not diversification, that's a bet. Growth has dominated for about 15 years, the longest streak in modern history. Every time it's run this long, value outperformed for the next 5 to 10 years. So here's what a smart retirement portfolio could look like right now. 30% SCHD in a traditional IRA, 15% VOO in a taxable account, 10% VXUS in taxable, 10% VYM in a traditional IRA, 5% QQQ in a Roth, 5% JEPI in a Roth, and the remaining 25% in bonds and cash as a spending buffer. That portfolio survived 2022 with roughly a 7 to 10% drop on the equity side. It throws off enough income to cover most of your spending without selling shares, and it's positioned for the decade ahead, not the decade behind. The best ETF isn't the one that grew the fastest, it's the one that lets you sleep at night and never run out of money. If someone you care about is picking ETFs based on a 10-year return chart, share this video with them right now. It could save them from a very expensive mistake. Which of these 9 funds surprised you the most, and are you rethinking where you hold it? Drop it in the comments. I read every single one. If you're building retirement income and want to stay ahead of the tax traps and market shifts that nobody else covers, subscribe to this channel. I break this down every week.